Is inflation making a comeback? What is the market telling me this week? What's up, super investors? Welcome to the Nick Rutherford Report. And every investor loses money, but what separates the best investors from everybody else is they make more than they lose. And anyone can do that when they look at the market to determine what to do. So hit that like button, subscribe to this channel, share this with someone who would get a lot out of it, because this is the place to be for the financial news that matters for your net worth. Let's get to it. One of the biggest advantages any investor can have is understanding where the market's going to go next. So I like to look at this piece of data from the University of Michigan, the inflation expectations. And if you look at this graph, you can see, well, inflation has been going down, while the expectations for inflation has been steadily declining. In fact, we're now in the typical range that we've been in since the 80s, give or take a little bit. And why is this important? Because so many commentators that I see out there are saying inflation could come back, it could go up. And I've seen a lot of articles out there really pushing for this, and I think investors should be cautious, and they shouldn't get caught up in the data. Get caught up in the emotions, and they should look at the data. And the data is telling me, well, people expect inflation to be kind of normal here. So let's also look at some other data that's kind of conflicting. Here from the Fed, we have the break-even inflation data. So the break-even inflation data is all about telling us what the market thinks the break-even is. So people think inflation is back to normal, but the market thinks something different. Because if you look at this here, it could be that we're breaking out right here in January. Now, also, the most important thing that I'm looking at is before the plague, it seemed that inflation expectations, or not expectations, the break-even inflation was between 1 and slightly under 2.5. And now it seems like we've really settled into a trend here of between 2 and 2.5, closer to 2.5, which is maybe half a percentage point to slightly more than half a percentage point higher. And I know that doesn't sound like a lot, but a small amount of extra inflation over a couple years all of a sudden compounds on itself and really erodes the purchasing power of the people who are most affected by inflation. And if you want to become a super investor, you need to understand the implications of this on the market. And that means companies that serve the lower income bracket are just not going to do as well as companies that serve the upper income bracket, or companies that are less affected by inflation. What kind of companies are those? Really simple. Companies that don't have as many things that are affected by inflation. For example, the ad network on Google doesn't require the same thing as, let's say, a home builder, where a home builder could have higher labor costs. They could have additional material costs, where an ad network on Google just keeps serving ads. They already built the infrastructure. There's not a lot to do. Maybe they add a few more data centers. Maybe they don't. Maybe it's all built. So it's something that investors should pay attention to, because I see all sorts of articles like this. In a parting gift, the current administration is sending oil prices soaring with some new sanctions. Well, when I see articles like this is just designed, in my opinion, to scare investors into doing the exact wrong thing at the wrong time so that Wall Street can take advantage of you. I want you to take advantage of the market, and we're going to watch the market, and the market's going to tell me exactly what to do, because, well, this just goes back to telling me that we are in a new regime. When I look at this, it tells me, well, we could have inflation, we could have tariffs, we could have trade wars. So I'm going to invest in the companies that take advantage of these trends, not the companies that are going to be impacted by these trends. So here is another article. Inflation expectations will keep rising in 2025, and it matters the most in Japan. Well, I'm a little concerned why people are publishing articles like this when we just looked at the data and the inflation expectations have been going down. So I'm not sure where commentators get their data, but as we just looked at, I always like to go to the source, because when you go to the source data, then you get the advantage. You're not getting swayed by Wall Street who wants to take your money, or some sort of commentator that wants you to pay attention to them, or some newsletter publisher who wants to scare you into buying their service. So to look at everything, we're going to look at oil, because oil is the master resource. It runs everything in the economy. And I'm sure you remember that after the plague, oil went negative and then it spiked up massively along with the war in Ukraine officially starting, and it spiked over $100 a barrel. That's when we were really having a lot of inflation, because oil runs literally everything, from the fertilizer to all of the diesel running the heavy equipment that's shipping all of your goods and services around, or not your services, well, all the goods that end up at your services. And when oil's high, that cost feeds through, creates inflation. And you can see right here that oil is really right now in the sweet spot. It's in that trend between 60 and 90, as they say, where oil producers can be happy and make money. And also, oil's not too expensive that it weighs heavily on the economy. So yeah, oil ticked up a little bit, but it's certainly not surging. It's certainly not near the danger zone. We can watch it and see where it goes. But that type of talk is just a big nothing burger to me right now. So I like to just keep an eye on the trends that I see are making investors money. And one of those trends is the government has been spending a lot of money pushing up assets, and one of the biggest assets taking advantage of that is Bitcoin. And Bitcoin has been down a little bit, but as you can see from this article, the Bitcoin January slump is nothing new in the post-halving years. So apparently, it halves, it goes up, then in January, typically it slows down, and then it goes up again. So this just tells me that, well, maybe we're on track. Now, I like to study the past to predict the future. So if I'm studying the past, well, January slumps are nothing new, so I perfectly expect the trend to be intact, and this is just normal. Now, of course, I have to watch the market very closely to see if things change, but it's just an interesting piece of data. And now the biggest thing when it all comes to inflation I want to keep my eye on is the 10-year Treasury, because it looks to me like we're approaching new all-time highs. If this busts out to new all-time highs, we could be in for a wild awakening where a lot of things change in the market. Because just imagine if you could get 6, 7, 8% from a treasury, would you be investing in a treasury over the S&P 500? It's something many investors would consider. So if this continues to rise, it will continue to put pressure on the government. The government will continue to have bigger and bigger deficits. The currency will weaken, potentially, or it will get stronger because everyone wants more and more dollars so they can get a higher and higher yield. It's really hard to say, and people on both sides of that argument will say both things. So I don't know, but I do know that it could profoundly change markets if it profoundly changes the public's psychology, because as a super investor, you have to remember you're not only just investing, you're investing in what other people think. Like, what do I mean by that? I mean, you're investing based on the psychology and the perception of other people and what they think the future will be. So I'm watching this because if this goes and breaks out to new all-time highs, well, we could have a problem in the market. And that's why I'm very closely watching the US to yen conversion rate. Because as the Japanese yen weakens and weakens, you can see that it's somewhat similarly tracking the yield in the bond market. It had peaks in the same place. It also coincided with the 22 low in the stock market. So I have a suspicion that there's a lot of liquidity coming from Japan and going into the US market. Why? How does that work? Why is it important? Simple. Imagine if you could borrow in a currency that didn't have as high of an interest rate and was depreciating against your currency. So you go to Japan and you borrow $1 million and you take it back to the US, you invest that $1 million, it goes up, and the dollar strengthens against the yen. Now, when you have to repay it, you only have to repay, well, 700,000. I'm just making that number up because it's depreciating against the dollar. So you get to make gains and pay back the loan at a devalued rate. So you're a complete winner. So this trend is really something that could be pushing up all of these assets, and it's something investors should pay extreme attention to, because if it changes and if it shifts, it could have tremendous implications. So that's just something that I'm watching. Now I want to dig into one last chart here that I'm watching, and this is the JOLTS quit rate and the JOLTS hire rate. So this is just something that's telling us something about the job market. And why do I say it this way? Because, well, it's all hocus pocus until it's not. And here's the thing. The amount of hiring and the amount of people quitting is looking very similar to last time during the global financial crisis. You can see that they've drawn these fancy dancy lines on here, and you can see that the last time it was this low, we were in the crisis from the plague, and we were in the crisis from the great financial crisis. So whether this means something or not, it's hard to say, but it's important to look at. Why do I say that? Because if the economy weakens to a point where it affects the earnings from the Magnificent Seven who are holding up the market, where all the AI and all of the data centers and all of the CapEx and all of the earnings are happening, if the underlying economy weakens to something structurally changes there, well, then it's going to be huge problems for the market. So because this is approaching this level, I'm very, very cautious, because we're entering a correction in the S&P 500. My version of a correction. What is that? It means the S&P is going down instead of up. If we look at the chart here, it's starting to dip. It dipped in July. It dipped way back here in April. And this is very concerning, because if we have a market momentum dip and we have a breakdown in the underlying data, then it's time to freak out. I'm not going to freak out until I see both. I want to see a deterioration in the market and a deterioration in the data. Because if they're not giving me the same signal, well, then it's not time to freak out. Because let's say the underlying economy and the jobs are strong and the market's weak, well, then it's just a correction. Let's say that the market is going up and the economy looks a little weak. Well, everyone who's in the know, the insiders, and they're bidding up the prices, they know that corporations are going to be more profitable. And then the labor market probably will fix itself. So the market sends me signals that I pay attention to, because it's like having a crystal ball into the future. So I really want to look at this to see if they're confirming signals. And if they're not going to be confirming signals, then I'm not too worried. So the levels that I'm really watching for is the S&P 500 to get down towards its 200-day moving average at 55.78. Right now, it's at 5,800, give or take. If it starts going down below its 200-day moving average and I see negative economic signals, that means I'm going to worry. It's probably time to take risk off the table. But until that happens, I'm not worried, because, well, the jobs data had looked strong enough and the market had been in an uptrend. So if we continue to see deterioration, then it could be a problem. But until then, I'm not worried. So this is just the data that I'm looking at. So hit that like button, subscribe to this channel, leave me a comment, and I'll see you soon. Next, what's the number one stock to buy right now? Click on my bio. Follow me and follow the link to RutherfordWealthReport.com, and I'll share my latest research with you.